Welcome to the Evolution Partners podcast, where I talk with the world's leading thinkers, planners, and doers who are helping to build great companies in their own way. We learn how the work they're doing is creating an impact and get to know a little bit more about them and what makes them tick. This episode is brought to you by Evolution Partners, where we help leaders to confidently build enduring great companies using our proven, structured, strategic planning process that ensures you build and execute the right plan. Check us out at evolutionpartners.com.au. Also, you can check out our books, Made to Thrive, outlining how to be a great CEO, as well as Onboarded, which is about making your new hires more effective faster. Welcome to the Evolution Partners podcast, where we talk about building enduring great companies. I'm Brad Giles, here with the summer series. I hope your summer is going well if you're in Australia, and of course if you're in the Northern Hemisphere. I suppose we're just winding you up a little bit with our summer series to say that there is another hemisphere and we exist over here. So I'm Brad Giles, joined today by Richard and Andreas, talking about the real challenges and opportunities of building better businesses. So welcome, chaps. I hope that you're well today.
Yeah, very
Thank
good.
you, Brad.
I usually say it's sunny in Sydney, but today it's very stormy in Sydney.
Summer storms in Sydney, not unusual, Andreas?
Oh, I'm very, very happy to be back and I'm a big fan of the topic for today.
I know. Let's use that as a catalyst to start with our word or phrase of the day. Richard, what might be yours?
Leaky buckets.
Leaky buckets. Very nice. Andreas?
My word is family. This is a time that I spend with family, doing a lot of different activities, and I really, really enjoy that part of the year.
Very nice. Mine would be confused. Perhaps the word you might think I would say, but leaky buckets, family, confused. I really put confused because when I think about the topic today, why don't I see a profit? Just can't help but think about the way that people feel confused by it. It's a really important topic for entrepreneurs, I think, to understand. So let's jump in. This is one of the most important or common frustrations that I hear from business owners who don't yet get it. Your accountant's telling you that you've made a profit. You're going, what do you mean we made 500,000 or whatever is the number? Your P&L's showing it, your accountant's saying it, and you're like, but it's not in my bank account. I don't understand. And it's confusing and it's frustrating. And it kind of tells you that maybe you're the only one that's going through it. I don't get it. Why am I so dumb? Or why is this so unfair? These people are lying to me, but it's not like that at all. It's simply a business process or distinction that you need to understand. So today we're unpacking why this happens, why the business absorbs your cash even when the profit and loss says that it looks good, and how understanding working capital can remove a lot of that confusion. So we know that you're not an accountant. We don't want you to become an accountant, but this is about understanding why it happens and what's happening to your cash and knowing that you can do something about it. Why don't I see a profit? Richard, maybe you could offer some initial reflections on this topic.
Yeah, I mean, it's very simple. Growing businesses need cash. And what we forget, I think, sometimes is that revenue and revenue growth is actually a cost that needs to be financed. And how do we finance that? With cash that is available, generated from the business. And I think too many situations we rely just on the P&L. I think you raised that right at the beginning. What we need to do is, and I try to think about doing all the time, is opening up that aperture to say, well, okay, so where did that cash go from a cash flow statement? So what was the starting cash and ending cash? Meaning, did we get more cash at the end versus the beginning of the month or the quarter? But we have to find where cash may be lurking. And that's where the balance sheet comes in, because sometimes we forget that there's this third sheet that has a store of cash that may not be being used in support of growth of the business. So all of these things, when we don't think about cash flow statements and balance sheets, we get confused. Your word, I think of a mirage of sustainability. You know, it's sort of it's that oasis on the horizon that really isn't an oasis. It's a mirage.
I think that makes me think about, and I'm going to come back to you, Andreas, in a sec. It makes me think the cash is there. You're just not managing it in a way that makes it spit out. Andreas, your reflections?
Yes, I remember a client telling me once, we made almost $1 million in profit and I still cannot pay myself accordingly. And I heard variations of that over and over. I've seen leaders doubt themselves because of this topic. Sometimes, they question their instinct in a way, and they start to feel alone because it's like there's a game and no one told you the rules.
Yeah, yeah. And it's frustrating. It just seems unfair because you're probably busting your butt trying to grow and putting all of the effort in, but it can be really, really tough. So before we go any further, let's just unpack this for a second. How do we end up in this situation? How do owners see a profit on paper, but they're not seeing money in the bank? What are the early signs that this is happening? Maybe Richard, any thoughts?
Yeah, well, maybe we need to unpack the concept of bank account. I think I think we have to think about the bank account of the business and the bank account or the personal bank account. And I'm going to start with that before I get into answering your question, which is I think sometimes when I get into working with folks, one of the things I really try to make sure I understand or if not put in place is there needs to be a flow of money to the personal bank account that is called a commercial and reasonable salary.
Yeah.
Because I think sometimes what happens in this world is, business owners get frustrated, confused, or they get worried, they start to question their ability, is that they make the misguided sort of decision that because, quote, they own the business and they get all the profit, funding their just everyday lifestyle should come first. So I want to make that point because I think getting a commercial salary as part of the flow of costs in the business is a starting point for this discussion. If that's the case, and we're not sucking it up and showing frugality to the team by not taking a salary, but let's assume we've corrected that problem, I think that there's like a series of steps. So next step, we paid a commercial salary. Then I sort of want to know, well, okay, have we got enough money to fund our cost of goods and the labor to produce that? Have we got enough money to cover 2 to 3 months of cash needs to cover OPEX, right?
Yeah.
Because what we're trying to get down to is then what is the free cash flow, right? That is not already spoken for, so to speak. And that's what I'm trying to get at. Because once we do that and we've accounted for all the things where people are going to be reaching into our pockets to take cash out of the business, including ourselves in a proper and robust way, we now need to figure out, so every time we add more revenue to the top line, how much more money do we actually need to fund that growth? And that's why, I opened with that comment. Because we need to be making sure that after all the hands have been sort of paid, including the government and ourselves, that the business has enough cash to actually grow the business and generate profit. Because if that isn't...
To grow the business, I just want to duck in there, to fund its growth as well.
Correct. Absolutely. And I think we need to establish those kind of first principles because then we start to be able to understand what cash is left over to either reinvest in the business, increase lifestyle, or to build assets outside of the business. But it's getting really clear about what are the buckets of cash that we're actually talking about. So I think that's kind of important. I think the other thing is that there's too much of an obsession with meeting all of the hands and putting cash in there, like the tax office and everything else. They're not the same as the needs of the business and generating profit to generate more cash above and beyond those things. So I think that's important. I think that's why, when I work with clients, people laugh at me, but I say my best friend has to become the CFO after the owner of the business, the CFO, because then I want to get down to a conversation with them about this so that we understand where cash is going, because a lot of the time that hasn't been explained to the owner. And I want the accountant to switch from an accountant to almost like a consultant or an advisor that says, I'm going to teach you where the cash is going so that we can have a clearer conversation about what are the surplus amounts of cash that could be flowing to you potentially as a dividend.
And that's somewhat the difference between an accountant and a bookkeeper and a CFO. Without overly labeling, we need to get accountants to help the entrepreneurs as well to understand that. Andreas, any thoughts on this?
Yeah, I really like your point on the principles, Richard. And based on those principles, I think there are like 3 views or 3 different principles of seeing the numbers in a company. The first view is the tax view, and that is the view that it was built for compliance. The other view is the accounting view, but that is the view that it was built to keeping the internal books in place. Probably what is missing most often is the leadership team view of the numbers. And that is a principle that is, as you said, Richard, it hasn't been explained because that is the view of the numbers that it should and it must help the leadership team make better decisions. So when I was working with a client in Adelaide, that was the first thing that we did. We worked really hard and it took its time to connect the financial numbers with the operating metrics of the business.
Mm.
And after a while, we started to see how every level of the company, they actually understood how whatever they were doing and whatever KPI or number they had, it was contributing to the performance of the business.
Yeah. Yeah. It's the insight, right? I guess for me, I think that one of the problems is that culturally within the accounting industry, I often see that accountants are paid by the business owner, but they serve the tax office. There is an oversight, a culture of compliance with the tax office being their first and foremost job. So the financial accounts are structured to deliver what the tax office wants, but as business owners, let's not forget the people who pay the accountants. We need management accounts so that we can deliver what the business owner wants, or perhaps the data that the leadership team needs to understand. There is a definite, very important compliance role with the tax office, do not get me wrong, but there is another role, which is giving the management accounts so that we can understand what's happening with working capital, what's happening with cash, I guess, so that we can predict and delegate in a more informed manner. So what's really happening here? When the P&L says that there's a profit, but the bank account doesn't show it, where's that money going? And why does the business absorb so much cash without the owners noticing? Richard, what's your thoughts on this?
It's kind of a multi-part answer, but I guess I always start with this idea that we need to be patient for revenue and growth and impatient for profit. So let's start that as a sort of a frame of how I'm going to answer this. What I think is too often the case is that there's a fixation that the P&L starts to create, which is everybody's looking at revenue and gross margin, revenue minus COGS. But I guess what I try to get people to start thinking about is what about the trends in those things? Because just reporting a P&L that says, well, my cost of goods is X doesn't actually tell you anything unless you see the trends in it. Now, let's say revenue is growing at 5%, but COGS is growing at 10. It's not going to take a genius to figure out that gross margin percentage is going to start showing a rapid decline. That compounds month on month, quarter on quarter. That is the real top line. And if that is now changing materially because of things, just even in COGS, I won't even go down below that for just a second, you're going to see cash potential. And interestingly, you extend that one layer further. If you then deduct out all the labor that generates that, you get down that gross margin, you get down to contribution margin. I'm not trying to teach people how to be an accountant or read a P&L, but this is important because, give an example, in a software business, typically they have astronomical gross margins. Why? Because they have very low cost of goods.
Yeah.
And so the gross margin calculation, the direct labor compensation are useful and interesting. How much labor are we invoking here? But again, that's a bleed on cash. What really gets interesting in those types of businesses is contribution margin, because now that's actually the real top line, right?
Yeah.
That's where we start. And I think, to answer your question more clearly is to say, what I get into often when I work with clients is starting to say, right, let's break this down, not line by line of your P&L, but the big categories: technology, marketing, management salaries, so on and so forth, right? Financing of the business, interest expense. Because when you start to walk through that, you realize that this illusory mirage of the big revenue top line that's sort of kind of growing is getting eaten up by all of these deductions, line item deductions that actually are really the levers that you can work with. And let me extend this software idea one step further. When we did that, what was interesting was that we started to realize that there was a better way. And the better way was to start thinking about how we could get to some operational levers, some things that people could do in the business. And one of the things we did was to focus on renewals. Why? Because this is a way to fund the business with cash in the door in advance of doing any real work, particularly in a software world, right? You're actually paying for the software well in advance. You're receiving delivery of the software. We get the money for it, but actually our cost structure plays out for months after that. And so it's a wonderful way to fund the model and have more cash in the bank, so to speak, that you could then use or choose to use in clever ways to grow the business. And what was really interesting about doing this is once we explained that and all these line item deductions, folks in the business could see a role that they could play to work on those levers. So the head of customer success in this case had a really clear view of what it would need in terms of numbers of renewals and dollar values of renewals and how that had to be achieved and when in order for the business to have a better cash position to invest in customer success, as an example.
The business must spin off cash rather than suck cash. And it is all of the levers in the middle that do that. Andreas, what's your thoughts?
And that's probably the key question, right? How do we know that a business is spitting cash or it's, as I call it, a cash vacuum, perhaps? So that was actually the question. I remember working with a consulting company here in Perth, and that was the question that we had. And so what we did was to calculate the cash conversion cycle. So that is the amount of days that your cash is tied up before you get it back. So as an example, you spend money on materials and, as you said, Richard, on labor. Then you wait whilst you are producing. And then you wait again whilst you're selling that product or service. And then you wait even longer, waiting for the customers to pay you. So that is the cycle. And the faster the cycle, the more cash you're generating. And the longer the cycle, that's how much cash your business needs just to keep running. So that is probably one of the simplest way to really understand that question. Are we spitting cash or are we consuming all of the cash?
Yeah, and I think you raise a really good way of looking at it, right? If we are waiting on cash to arrive, but expending all of those line item deductions, right? This is how we explain where on paper it looks like profit, but actually all of it is getting redeployed or held in a sort of abeyance until somebody is able to release it by getting paid. And it's part of, the broader question that, the broader answer that you were looking for, Brad.
Yeah, so the cash conversion cycle has 4 components broadly averaged out for each business. Every business is different. And so it's sales and marketing is the first component, make and production, delivery, and then finally cash collection or the collection component, the payment cycle. So those 4 components each constitute a series of days, and we need to compress those. The old story, of course, is Michael Dell, who in the early days was growing so fast, he couldn't get enough investors to continue to pile cash in because he just kept on needing it as he grew. And so instead, he switched and compressed his cash conversion cycle by analyzing all of the different components in each of those areas. For example, in China, he would compress the delivery cycle by putting the suppliers, if you want to supply to Dell, you need to be on the same street as us. If you want to supply to Dell, you need to have 60-day payment terms, a lot of those types of things. If you want to buy a Dell computer, you need to pay for it up front. So there's a lot of things that he did in that, to the point where he took that cash conversion cycle from plus 64 days, meaning from the beginning of the sales cycle to cash in the bank, it was 64 days. It requires a lot of cash every time you add another million to minus 21 days. All of the things he did along there. So the cash conversion cycle is a really important tool. But I think it broadly more makes me think about the old statement from Alan Mills, which is revenue is vanity, profit is sanity, and cash is king. So you better make sure that your cash is right. And I suppose it comes back to as well, impulsive risk takers from the Bigger Isn't Better, Better is book. So those who are impatient and undisciplined, who are just chasing revenue at the expense of everything else, where it's much better to focus on compressing that cash conversion cycle, understanding where the cash is going, and then making sure that the business model works. So I guess what's reassuring is that once the owners understand this, it all starts to make sense. There is this hidden component of working capital that operates in the business. And once you understand your days and you can compress that, you can understand where the cash is going, why it's happening, and you can begin to take these structural, often quite simple changes to be able to work on that. And this is where the working capital penny drops for many of these business owners. On this podcast, I had Greg Crabtree, who frankly explained it better than anyone else that I've heard. He, in his book, Simple Numbers, calls it trade capital. And the formula is pretty simple. It's receivables plus inventory plus work in progress. Let's take that, minus payables, minus accrued expenses, minus deferred revenue. So you may need to look in the show notes or you may need to look at that book. But what that really gives us in his very simple terms is a formula that tells us, are we spinning off cash or are we sucking cash? And so that deferred revenue just means the money that you've been paid up front or you haven't delivered yet. And so the cash hits your bank, but the P&L can't count it as revenue until you actually earn it. So it's the timing difference that really matters. So once you get and can implement this formula, you can understand if it's a cash eater or a cash creator as you grow. Ideally, like Michael Dell, the faster we grow, the more cash we spit out. The problem is that for many entrepreneurs, they get into the situation where the faster we grow, the more we've got to feed the beast, the more we've got to keep pumping cash in. No real cash coming out, because as soon as we solve this month's cash problem, we need more cash to solve next month's cash problem. And the banks love you, right? Because they're going to keep selling you debt. But there's a smarter way. So let's have a look at what it really means in business. So what are some examples perhaps of owners who were profitable on paper but starving for cash, and how did that change? Any thoughts, Richard?
I mean, perfect situation. I was working with a client almost a year ago, and I was doing my usual sort of make friends with the CFO, and I had just this like horrible moment when I realized why the owner was so frustrated and sad and unhappy and was considering his business as terrible was actually because of how cash was being managed. And let me expand on that. So they're a design, construction, installation business. And the crazy thing that was happening was they were recognizing all the line item deductions every month and having to pay for that. But they were only truing up to revenue once a year because it was, quote, too hard to recognize revenue in the P&L. So why would this be a problem? Well, they had to finance or find alternative sources of cash or eat into the balance sheet to keep funding the business for about 9 to 10 months. And then miraculously, the business showed a profit in the 11th/12th month. And at which point then the client was more happy, but still was really mystified by his business. So what we ended up doing was we, using some of the work you've mentioned in terms of Greg and his simple numbers, we basically got to a view where we restated all of the accounting view to a management view that, whilst the accountant could still live in his world of, beautifully constructed spreadsheets, and I don't mean to sound derogatory, but it was really problematic. But when we looked at revenue more from a management view, like what's actually happening in each month, suddenly we had actually a business that was actually more pleasing, more balanced, more clear. And because we understood all the things we've talked about up until this point, we then started to be able to understand the decisions we could make better to play with cash conversion cycle, play with operating levers, to understand the real flow of the business. That had been going on for, well, let's just say too long. And so we had a miserable owner falling out of love with his business, desperately trying to figure out how to fund it, when in fact it was there. It was just not being presented right. And this kind of illustrates a number of things we talked about. What are the first principles? What are the line items we need to worry about, so to speak? But more importantly, we need to get to a point where we need to worry about looking at it from a management view. What is the business really, really, really doing? And once we did that, we realized there was whole heaps of cash all over the place. They were just on the wrong balance sheet or placed on the balance sheet or in the wrong place from a treatment perspective. But it's getting that right, because once we knew that, we could actually start to invest in the business appropriately, knowing that through flow as well as reserves and deposits paid on the balance sheet, we actually had enough cash. We just didn't know where it was and we didn't have clarity.
It's such an important point. It's a bit like the business model. The business model must support the business activities. And one of those things is spinning off cash in the same way that rectifying, getting these systems and processes that mean that you can spin off cash rather than suck cash really matters. And
Yeah, so that reminds me of the first time that I met the owner of a trade business. And so they were doing all the right things on paper. They had profitable jobs and they had a very good demand of those jobs. But obviously, in the background, the owner was yelling, "Show me the money." So when we actually dug in, we understood and we actually saw the usual suspects. Some clients, perhaps commercial clients, paying in 60 to 90 days, and probably too much stock in the warehouse. This is what Greg
yeah,
Crabtree, one of my heroes, he calls that the profit on the shelf. But here's the real kicker. Probably the two things that nearly broke the business. The first one was that they were growing, but they didn't have a trade capital process. They didn't have a system in place to manage and person accountable for that. Not only that, their pricing model didn't support the cash cycle days. So in other words, their margins didn't match with a 60 to 90 day cycle of cash.
yeah.
So that's why they needed more cash to, as you said, Brad, to feed the beast every single quarter, every single year. But the final piece, and this is probably where everything clicked for the owner, was that the owner realized that he was treating profit as cash. And that was a turning point. Because once he understood, all right, so this is one thing and this is the other thing. And not only that, this is how I understand trade capital, and gave each of the levers to his managers. Then they understood where the cash was hiding. And actually, most importantly, perhaps, is how to go and get it back.
Yeah, I mean, Andreas, you trigger something. I was just in a session today with a client, and we were talking about a supplier needing extra deposits in support of some very big orders of merchandise or product that we were buying from them. And, all the fretting was about getting this deposit in place so we could assure that we had a good supply. And my question to them was, I said, okay, I get all the risks of that, all of the challenge that. I said, but so did we price this into the deal to the customers who are buying that product? Meaning that we have to put these deposits into somebody else's business, move our cash to somebody else, and we're essentially financing our suppliers for a period of time. Have we priced that into our deals? And it was just that simple question when everybody went, oh my God, we've never thought of it like that. I said, I understand you enjoy great relationships with your partners and your suppliers. You want to do the right thing. I said, I'm not objecting to any of that, but if you're going to do that, as Andreas just highlighted there, make sure that then turns into a proper business model discussion, proper pricing model discussion to make sure your deals are priced for the fact that you're tying up your cash for 60, 90 days with a supplier.
It's just maths, really. When you think about it and you analyze it, there are all of these series of calculations that mean at the end, how much cash do I spit out? What is happening there? I mentioned Alan Miltz before, who has the power of one, 7 levers inside of the business. And this is all maths. If all of these things equal out, then we're spinning off cash or we're sucking cash. And you can adjust these 7 levers: revenue growth, cost of goods sold, percentage growth, inventory, accounts payable days, accounts receivable days. I haven't got 7. I can't remember the other one, but this is just a maths problem. It does make me think about a retailer who I know where we grew for 15 years and there was new stores and more stock and new stores and everything was going great and the growth story was fantastic, but the business just kept sucking cash over and over and over. And the owner said to me at one point, where do I get a return? I just keep pouring into it. Well, it's the decisions that we make along the way that dictate that. It is the decisions around that maths. What do all of these best practices and stories have in common? I mean, the real turning point is when they finally see that profit and cash are not the same thing. The profit that you see is not your ATM. It is a completely different thing. And I think it's probably the thing I'd reinforce for the better financial section of the Bigger Isn't Better book, because there we say that the business should produce 3 streams. One is to fund the business, one is to fund your lifestyle, and the third is to build wealth outside of the business. But that's not the profit, that's the cash that comes out of the business. And so the profit and the cash are different. So you've got to understand that they both are measured and operate in different things, and that working capital is the bridge, understanding that between profit and cash. So when you understand that, your frustration, to my opening word, disappears. You're not doing anything wrong. So for a business owner who's listening right now, what should they do to act on this issue? Rich, what do you think?
Well, I mean, I think we've given lots of very practical and very clear directions, but I'll do it in 6 words. The first 2 words are management reporting.
Yeah.
If you don't have it, get it. Insist on them. Get the reports, get the dashboards. Make sure you understand where cash goes and the cycle of your cash. So management reporting is about that, not just the statutories that make the taxman happy. We need to make the owner happy. The next 4 words would be customer-funded business model. Everything that you can do, you gave the great example of Dell, which is one of those ones that we've used many times on the journey with our clients. But the more you can get cash up front and realize that from your customers before you expend cash procuring supplies and freight and everything else, the better position you're going to be in, because you've got essentially a larger float to work with at any given time. So those are the 2 words, management reporting, and the 4 words, customer-funded business model.
Andres, what should owners do to act on this issue?
The one thing that I would say, or 2, if I may, because why not, would be the number 1, map your cash conversion cycle in days. And then share that with your leadership team and go through these levers and try to find these small increments that the compounding of those will get you to the cash. Think about, maybe it could be chasing overdue invoices. This is what Brad, you mentioned as the receivables lever. Maybe it could be renegotiating some suppliers' payment terms, and that is the payable lever. Maybe is getting rid of excess stock, perhaps, and that could talk to inventory, or probably get a or front payment for the next job, being the refer revenue, perhaps, that we mentioned before. But any of these things, look for the 1% 1-day increment. This is what Alan Mills talks about in The Power of One. Is the one thing every quarter that we can do, and the compounding efforts of that will get your cash back.
I guess for me, get management reports to do your job. If you are frustrated or confused because you're not seeing profit turn into cash, then I would suggest that you're not getting the right information to do your job. And that means understanding or getting the report, which clearly states what is the working capital amount, what is my cash conversion days. So working capital amount, for every $100 that you add on to the top of your revenue, for example, for your revenue, how many dollars is eaten up by working capital? Understanding to that level, as well as the days. Get the management reports, because if you don't have the correct reports and you've got the tax office reports, that's all well and good, but you can't do your job as a leader. So as we move to close, what's one takeaway each for leaders on this topic, Rich?
Challenge your CFO. If challenge is too soft a words, put it in his job role scorecard that he explains cash to you and cash conversion cycle to you like you're a 2-year-old. Not because that's insulting, but because actually it is quite simple, but just get them to do it because it is so important.
Andres?
Good. For me would be teach the cash conversion cycle and the levers to your team so they can actually go and get your cash back.
I think for me it's take action. We've highlighted some really simple points here. Take action. Don't stay frustrated. So thanks for joining us today on the Evolution Partners Summer Series. I hope that you are gaining value and getting some insights and, maybe learning a little bit along the way as we continue through this summer of 2026, enjoying our time. together. You can, of course, find us at evolutionpartners.com.au, and you can check out our books, Made to Thrive, outlining how to be a great CEO, Boarded, about bringing your new hires to the point where they're more effective faster, and then finally, Bigger Isn't Better, Better is Better, avoiding the pressure for endless growth to build a better business and life. My name's Brad Giles. Thanks again, Richard Andreas, for a great day. And for everyone who's listening, do enjoy your week. Well, I hope you enjoyed the episode as much as I did. If you'd be kind enough to leave a review for the podcast, that'd be really helpful to other like-minded entrepreneurs, and then we can grow our community. If you want to find out more about our guests, head over to evolutionpartners.com.au/podcast, where you can find show notes and other additional reading. Hope to see you back next week. Until then, keep thriving.